Curious about turning $100,000 into a financial powerhouse portfolio worth millions? Even better, want to know about a portfolio that can pay over $100,000 in dividends alone? Today, I will be showing you 3 best performing ETFs that can turn your $100,000 into a financial juggernaut. I will show you how these ETFs stack up, the unique strategies, and precisely how much you could earn from each one. Spoiler alert, one ETF has the potential to be an 8-figure investment value. In the end, I will show you how you can combine the 3 ETFs into a portfolio, make it less risky, and still make over $100,000 in annual dividends. Let's start with criteria for selecting ETFs. When it comes to choosing the best ETFs for my, or for that matter, your portfolio, having clear and effective criteria is essential. I look at the potential for generating consistent income, focusing on ETFs that provide a steady stream of dividends to grow my investment while offering passive income. Capital appreciation is also crucial to me, so I select funds with a track record of increasing in value, significantly boosting my overall returns. Diversification is key to managing risk, ensuring that my ETFs include a variety of holdings across different sectors. Keeping costs low is vital, so I prioritize ETFs with low expense ratios to keep more of my money invested. Lastly, I seek stability and reliability, selecting ETFs that have performed well over time and demonstrated resilience through various market conditions. By focusing on income generation, capital appreciation, diversification, cost efficiency, and stability, I identify ETFs that provide a robust foundation for my long-term investment success. With these criteria in mind, let's begin by discussing my first ETF for today. In the sector that is mostly overlooked by investors, the mid-cap stocks. For this, we have Vanguard Mid-Cap Index Fund ETF shares, commonly known by its ticker symbol VO. Launched in 2004, VO aims to track the performance of the CRSP U.S. Mid-Cap Index, which measures the investment return of mid-capitalization stocks. With assets totaling over $160 billion, VO is one of the most popular choices for investors looking to capitalize on the growth potential of mid-cap companies. VO's portfolio is composed of stocks from a wide range of sectors. The fund holds over 330 stocks, with the top sectors being technology, industrials, and healthcare. This diverse mix makes sure that investors are not overly exposed to any single sector, thereby spreading risk and offering stability. Some of the top holdings in VO include well-known companies like Cintas Corp, Welltower Inc., and Microchip Technology. The performance metrics of VO are quite compelling. The current dividend yield is 1.55%, with an average dividend growth rate of 12.50%. Over the past decade, VO has achieved an average annual share price growth of 7.56%. Based on these figures, if you invest $100,000 in VO, your investment is projected to grow to $109,110 after 1 year. After 10 years, this investment is expected to reach $247,909, more than doubling your initial amount. After 20 years, the investment is projected to grow to $685,609, showing the nature of compound growth over the long term. And after 30 years, your initial investment could potentially grow to an impressive $2,257,758. After 30 years, you could receive $124,458 in annual dividends, which translates to about $10,372 per month. The total value added to your portfolio would be $2,157,758, with $1,343,821 coming from capital appreciation and $813,937 from reinvested dividends. The projections and targeting of the strong mid-cap market are the reasons why this ETF is on my list of strong portfolio additions. VO covers strong mid-cap growth stocks. However, to ensure stability and consistency in our portfolio, we also need strong and established dividend stock ETFs. That's where our second ETF comes in. Schwab U.S. Dividend Equity ETF, known by its ticker symbol SCHD. Launched in 2011, SCHD aims to offer investors exposure to high-quality dividend-paying stocks in the U.S. market. This ETF has over $52 billion in assets, making it one of the largest in its category. Despite its size, SCHD has an impressively low expense ratio of just 0.06%. making it an attractive option for cost-conscious investors. SCHD's stock selection process is stringent, focusing on financially robust companies with a solid track record of dividend payments. The criteria include a minimum of 10 consecutive years of dividend payments, a minimum float-adjusted market cap of $500 million, and a minimum 3-month average daily trading volume of $2 million. Once qualified, stocks are further ranked based on dividend yield, 5-year dividend growth rate, financial health, and return on equity. This makes sure that SCHD's portfolio consists of companies with strong fundamentals and consistent dividend payouts. The ETF holds 103 stocks, with the top 10 holdings making up approximately 41% of the fund. These include renowned companies like Amgen, Chevron, PepsiCo, Pfizer, Coca-Cola, Verizon, and Texas Instruments. These industry giants are known for their stability, profitability, and ability to generate steady cash flows, making SCHD a reliable source of dividend income for investors. This is proven by the strong performance of SCHD, with a current dividend yield of 3.48%, an average dividend growth rate of 10.87%, and a 10-year share price appreciation average of 7.19%. It provides a solid mix of income and growth. Now, let's talk numbers and future projections. If you invest $100,000 in SCHD, after 1 year, this investment is projected to grow to $110,670. After 10 years, this investment is expected to reach $291,863, almost tripling your initial amount. After 20 years, the investment is projected to grow to $999,292. And if you're in it for the long run, after 30 years, the initial investment of $100,000 has the potential to grow to an astounding $4,283,606, paying $363,020 in annual dividends, which translates to about $30,252 per month. The total value added to your portfolio would be $4,183,606, with $1,976,025 coming from capital appreciation and $2,207,581 from reinvested dividends. This highlights the importance of not only choosing the right ETF, but also the power of reinvesting dividends for long-term growth. No doubt, these returns will make you think this ETF is the best, but stick around, as the next ETF has the potential to reach 8 figures. In the end, I will show you how to combine these 3 ETFs to create a juggernaut portfolio that consistently pays over $100,000 in annual dividends. Now that we have covered both high and mid-cap dividend stocks, we also need an ETF that focuses on the booming industry of tech. For this, I have a perfect ETF, which is Vanguard Information Technology ETF, known by its ticker symbol VGT. This ETF was launched in 2004 and is managed by Vanguard, one of the most respected names in the investment management industry. VGT aims to track the performance of the MSCI U.S. Investable Market Information Technology 2550 Index, which is composed of stocks in the information technology sector. With over $80 billion in investments, VGT is a significant player in the tech-focused ETF space. VGT is exclusively focused on the tech sector, which means it includes companies that are at the forefront of innovation and technological advancements. This ETF holds about 316 stocks, with top holdings in industry giants such as Apple, Microsoft, Nvidia, Broadcom, and Advanced Micro Devices. These companies are leaders in their fields and are known for their rapid growth, profitability, and ability to drive technological progress. The performance metrics for VGT are impressive. The current dividend yield is 0.62%, which is not on the high side, but then again, the tech sector is not known for its dividend, but for its growth. It still has a solid average dividend growth rate of 14.36%. But most impressively, over the past decade, VGT has achieved an average annual share price growth of 19.76%. Let's look at the future projections. If you invest $100,000 in VGT, this investment is projected to grow to $120,380 after 1 year. After 10 years, this investment could reach $632,147, multiplying your initial investment more than 6 times. After 20 years, the investment is projected to soar to $3,927,395, demonstrating the power of tech-driven growth. And after 30 years, your initial investment has the potential to grow to a remarkable $24,158,075. The dividends, while modest compared to the growth, are still noteworthy. After 30 years, you would receive $24,977 in annual dividends, which translates to about $2,081 per month. The total value added to your portfolio would be $24,058,075, with a staggering $23,852,478 coming from capital appreciation and $205,597 from reinvested dividends. These numbers look very good, but does this mean you should go all in on VGT? The correct answer to this is a big no. Even though VGT has the highest portfolio valuation after 30 years, it is also one of the riskier approaches to investment. So what is the solution here? The answer is a well-diversified portfolio. Diversification is key to managing risk while maximizing returns. By spreading investments across different sectors and asset types, you can protect your portfolio from significant losses if one sector underperforms. By combining SCHD, VO, and VGT, you can achieve a balanced portfolio that leverages the strengths of each ETF. SCHD provides a strong foundation with its focus on high-quality dividend-paying stocks, offering stability and consistent income. VO adds a layer of growth potential for mid-cap stocks, providing a blend of stability and higher growth rates. VGT injects high growth potential from the tech sector. This combined portfolio results in some impressive metrics. The portfolio's current dividend yield stands at 1.88%, with an average dividend growth rate of 12.58% and a 10-year share average growth of 11.50%. These metrics provide a solid mix of income, growth, and stability, making the portfolio well suited for long-term investors. Looking at the projected returns from a $100,000 investment in this combined portfolio, the numbers are quite promising. After 1 year, the investment is projected to grow to $113,387. After 10 years, it could reach $354,163. After 20 years, the investment has the potential to grow to $1,279,154. And after 30 years, the portfolio could be worth $4,721,698. In terms of dividends, after 30 years, you could receive $106,246 annually, which translates to approximately $8,854 per month. The total value added to the portfolio would be $4,621,698, with $3,824,694 coming from capital appreciation and $797,004 from reinvested dividends. What this means is that by diversifying across these 3 ETFs, you can capitalize on their individual strengths while reducing risks. This approach not only enhances growth potential, but also provides a steady income stream, making it an excellent strategy for long-term wealth building.